Welcome back to Clear Path Retirement Radio. I'm Stuart Smith, and I am here with Mitch Davies, and we are all set for Mitch's Market Minute. Take it away, Mitch.
Excited as always, Stuart. We're going to get started with the same structure that we've been following. I'm going to break down what's going on right now, where we're at today, where we're at for the year, what we're watching, what's coming up, and then where's our focus for the year, right? What trends are we trying to follow? In what ways are we trying to bring value, that sort of thing. So to start off, the S&P, it's been a couple rough weeks. Last week was choppy. This week started off slow. As we're recording here today, it's up a good bit. But S&P is sitting right around mid 6,800. The Dow is just under 50,000. We saw it eclipse through. So we've seen all-time highs this year, but it's that same trend as last year where even though we're moving up and to the right, the red days feel heavy because of all the news coverage, because of all the AI bubble, is whatever is going on. There's a lot of negative coverage. And again, the news is designed to do this, to get views, induce fear, whatever it is, but these red days feel heavy. So it's important to, in times like this, zoom out and look at where these companies are at. There's some deals in these bigger tech companies that are down a ton, but overall we're still holding up okay. We're still right around where we started the year. We still had a great year in 2025. We had 2 amazing years prior to that. So we're still doing okay. The big focus we're looking at right now in the economic state is the jobs unemployment reports. We had the jobs report earlier this week, and it was great. We saw 130,000 jobs. Analysts were expecting around 60, 65,000. So that was double what the expectation was. And this is going to be the focus for the year because all the news articles, every headline is talking about AI and is it replacing jobs? And we're all kind of panicking as we're watching these unemployment numbers come out because we saw an unemployment report, I believe it was last month, in the mid 4%, which is the highest we've seen in years. Now this most recent one was a couple percentage points down. It came in at like 4.2. Analysts were expecting higher. So we're still seeing jobs being added, and weekly jobless claims are still in the low 200,000s, which historically is very stable. It's very indicative of a strong economy. And so we're going to be watching that carefully. We're going to watch that going forward. The other thing we're watching is when we see these strong job reports, what happens is the Fed can kind of take a pause on rate cuts. The market's expecting 2 to 3 rate cuts this year, depending on where you look. And it's almost counting on it, you could say. We need these mortgage rates to come down. We need the current office is pushing for that. So we want to watch, there's kind of a balance there between strong labor market and the rate cut. So we're trying to watch that. The main thing we're watching in the market, last week we talked about the sector rotation, coming out of some of these big tech companies and into consumer staples and that kind of thing. The main focus now with these tech companies seems to just be that the only positive catalyst they have are just spending money. We have this, you may have heard this term CapEx, which just means capital expenditure. And these companies, the way they're exciting investors is just by announcing that they're spending money. And that worked all last year. We saw all these big companies make partnerships with other big companies and announce that, I'm sure you guys have heard these data centers. They're announcing these big things, which is great. But at a certain point, investors are getting tired of that. So that's where we're seeing the big names down 10, 20% on the year, like the Microsoft, NVIDIA, and Tesla, and Amazon. And they're shifting into, again, this consumer staples, consumer defensive sector. And you could say that they're worried about overcapitalization on these companies, whatever it is, but this sector is doing well. So again, one thing I want to challenge you guys to do today is if you take a look at your portfolio for the last 2 years, and if you feel like it's just all these tech ETFs, which has kind of been the thing for the last few years, is just buy the NASDAQs and these overall ETFs and you've done well, take a look at that. And if you're, especially in retirement, and you're extremely exposed to that, I challenge you to just look at that and see if maybe shifting some of that could make sense. Yeah. So
and to some of these consumer staple plays that we like so much right now.
That's right. Yeah. So that's where I wanted to focus on today. We'll look forward to talking next week, and take it away, Stuart.
Absolutely. Well, great job, Mitch, as usual. Very, very insightful. I think, just to expand on that a little bit, I think we're getting into this unprecedented, time now to where it looks like we could actually have increased productivity in a lot of these companies while unemployment is going up at the same time.
Yeah.
And I find that fascinating.
We've never seen it.
Like, we've never seen that
Yeah.
in the history of industry in this country. And so I'm just real curious at how all that's going to play out. And we're certainly going to be keeping our eye on it. But just imagine that, where we're actually losing jobs, but companies are becoming more productive. And through the use of artificial intelligence and all of the other wonderful things out there. So we'll keep you posted on that.